Hello, students. I want to talk about our discussion topic this week, and it is about mutual funds, ETFs, and real estate. And as you know, I asked ChatGPT to create a lecture for me. That way, I can talk about it. And I gave ChatGPT what I have posted on the discussion board. And here is what I am going to talk about in terms of how to invest. And what is good is that if you might say you don't have a lot of money to invest. That's okay. Here is written you have $50. That's great. No problem. I know many people are students. You don't have a lot of, many of you might not even work. And you might say that, oh, I don't have $50. You can start even with $10. If you have $10, you can invest it. And we will talk about that, how to, make sure your portfolio grows. And then it is here. And first of all, we want to know what mutual funds are versus ETFs, exchange traded funds. And as we said, mutual funds are baskets of the stocks. Let's say you might say you are worried about buying stocks of Amazon because you might think that Amazon stocks might drop from $200 to $100 and you lose almost half of your $200. Can it happen? There is a possibility. It has happened sometimes, or it might not happen overnight. It might happen over a period of 5 years. You buy it for $200. 5 years from now, Amazon from 200 might become 1,000 or it might become $100. It all depends. Because you don't want to put all your eggs in one basket, you go and buy mutual funds. In these mutual funds, as we discussed in the past, there is not just one stock, it is baskets of, stocks. And let me show you, ask ChatGPT to show you what we mean by baskets of, stocks. And here is ChatGPT. Hello, please tell students what the holdings of SCHD are. That means what are the components? Imagine that SCHD, right, in English. Okay. And it is going to, I am just going to show you, here is SDHE is an exchange traded funds and is going to give you, suppose you buy one share of SCHD. SCH is Schwab, DFT comes from dividend. Therefore, when you buy one share of it is $48. Imagine you are worried about putting your $48 in one basket. You buy one share of SCHD and Schwab distributes it between all these companies. You might have heard some of these. You might have heard of Cisco Systems. That's a technology company that gives dividends, And this fund, the other let's say $48, one share of it is $48. 4% of that for the $50, for example, that means $2 goes to, they put it for you in Cisco. $2 on this is a drug company because they give a lot of dividends. And Merck, I think these are the of the fund. Yeah, that's correct. They are the 4%. 4% of $50 is around $2 of it. They put it in Lockheed Martin. Chevron, you know what Chevron is because they give you, this. Therefore, these are the top holdings that make 40% of those funds. Therefore, now it says it is ETF. ETFs are similar to mutual funds. We will discuss about their differences, but think about them as very similar to one another. We go back to our lecture, and here is lecture. And when we come here, here. Let me see where I got the lecture in here, and let's see. Here it is. And both differentiate, they are based on diversification of, they are diversified. When it says diversified, that means they are baskets of the stocks rather than one, single stock. And here, funds are priced once per day. That means that when you buy a mutual, as we said, we just talked about SCHD, which we said it is a exchange traded funds, and it is around we said $50 one share. Now, if imagine that Cisco, which was one of the components, the value of Cisco goes by 1 cent or 5 cents, this mutual fund, which was 50 cents, imagine other stocks don't go up. One of them goes up, for example, by 50 cents. Maybe the impact of it is 1 cent on the mutual fund, on the exchange traded fund, it goes up by 1 cent. Do you see that? Therefore, and it happens instantly. That means from 9:30 a.m. that the stock market is open until the closing time, which is 4 o'clock. That's going to happen. Of course, there is aftermarket trading as well, but they call it thinly traded time. That is when they are not that much of all the investors, those who in Wall Street go and they sleep and they go after they get off. Therefore, they are not that much activities. Therefore, these prices change during daytime, instantly they go up and down. But here in mutual funds, there are some mutual funds that they can sell you some dividends. But what will happen is that the price doesn't go up instantly. When they close the market, then those mathematicians sit down and do the calculation to see how much things went up or down. They do the calculation at the end of the day. Then they say, okay, things went up at 50 cents. Therefore, your mutual fund goes up at 50 cents. You will see the increase after they close the market. But here you will instantly see the increase if you buy ETFs. Very easy to buy. Those of you who have account with Charles Schwab, some students have, you can buy a whole share of ETFs. But Schwab doesn't sell the fraction of one ETF. That means that if you have $50, if you have, let's say, $5, you won't be able to buy, suppose, a portion of an ETF, which is $50. You have to buy a whole share, while you could buy a portion of a single share of a stock, and mutual funds have similar, but they have loads. That means they have fees. But those fees are very minimal, very, very depending on, of course, mutual fund. And sometimes they require 1,000 to 3,000 minimum, not always, sometimes. And then some of these funds, they call it front end load. That means when you want to buy, you pay a little commission maybe at the beginning, or when you sell, if it is back end load, when you sell them, you pay a little bit commission. And usually commission is very important to understand the concept. Usually when you buy from major brokerage firms, you don't pay a lot of commissions, because if there are a lot of commissions, the people don't buy from them. As I said, those of you who buy stocks from discount brokerages, those stocks you don't pay any at all. And then here, when you buy ETFs, of course, you do not see necessarily a commission when you buy them. That doesn't mean necessarily you will see. Let's say you want to buy $50 of an ETF share. The cost to you is only $50. You don't see that commission right there. What happens is that this ETF is around $10 billion fund, and that 10 billion you are buying, excuse me, only one share of those $10 billion, for example. And then the managers who are managing it for you, who are smart people, who are big-time financial advisors, they want to have, for example, some salaries. Who is going to pay for it? Maybe after, let's say, 5 years of having that $50, maybe 2 pennies of it might go for that manager who is managing. That's not a lot of money. Let's say your $50 that you have bought, let's say every year, very little, not even 1 cent of it goes for the manager. Therefore, it is that means that those are the fees that they have. I called it commission. Maybe I should have called it fees. Therefore, when the people, the financial investors, try to buy ETFs. Those who pay a lot of money, they invest significantly. They pay a lot of attention that to see how much the managers are charging those ETFs. If it is 1%, that's a lot of money. You put $100, for example, and then at the end of that, they get $1 of it. That's a lot. But this 505 means if you put $100, for example, at the end of it, they get 5 cents. No problem. If want 5 cents, that's no problem. But $1, for example, is too much of a money that they want to get. In fact, I asked some students to open a brokerage account. They opened some with Charles Schwab. And then, as you know, someone told me, I asked students to go and open with another brokerage. They said that it is called Cash, and they said that that company charges 3% every month, has a fees. I said, look, these students only have getting $50. If they have to pay $3 fees for that, then in 1 year you multiply 12 by 3. That's $36. The other their $50, $36 of it goes for the fees. Therefore, their money will be zero after 1.5 years. 14, 15 months. They said, no, they are going to open with some brokerages that there are not any, monthly fees. And then we opened many of them opened Charles Schwab, some opened Fidelity. Therefore, these fees, or you do not need to be worried about these fees in here as much because you are not for now a major investor. But if you have $1 billion and you want to invest, you would say, why, should I give 1% supposed to some funds that why there are other similar funds that are charging only 0.5%. Let's just be realistic. When it is 0.5%, that means from every $100, they give only 5 cents, from every $100 they give 5 cents, which is not significant, because if you have $100, it goes up by 10%. That would be $110 after 1 year. Therefore, they make $10 for you. Now, it's okay to give them 5 cents. You don't mind, that means you get $9.95 of net, profit from that $100. Okay, we give 5 cents to that good manager who ran that fund. But if that manager wants to get 1%, that means if your fund you invested $100, next year it became $110. That manager wants to get $1 of that $10. That's a lot of money. No, you don't want to give that $1. You will go after. You look at how much a fund, expenses are. And those who buy stocks, they are not worried. The students, when you buy your own stocks, you are managing it your own. When you go and buy Apple, there is not any from Charles Schwab and discount brokerages. There is not any commission. Therefore, you buy one Apple for $50, $200, it stays $200. There is not any commission. These commissions these fees, I don't call it commission. These fees are for ETFs and for mutual funds. And as I said, these are excellent investment vehicles for students who say they are worried about buying individual stocks. They don't know what to buy. As many students say, therefore it's okay. You will go and find some exchange traded funds. Here is a good one, VOO. That is, V means Vanguard. Imagine that you have $500, for example. You want to buy, you don't know what to buy, and you are so worried. In that case, a good financial advisor said, don't worry, put your $500, buy one share. If you have one share of this is $600, For simplicity, I say 500. Therefore, you buy one share of VOO, which is a very important fund, which means what will happen is that those managers take your $500. On average, they put it in 500 different companies that are in S&P 500. What companies we said are in S&P 500? You can go to Google and say, what are the components of S&P 500? You will see, you will know a lot of them. Coca-Cola, Pepsi-Cola, Walmart, Amazon, Google, all of them, those five. Therefore, that $500 of yours, $1 of it goes to Amazon, $1 to Coca-Cola, $1 to Walmart. Therefore, your money is distributed in S&P, and which is great, and then you will see that it goes it increase it the value of S&P goes up your at an average of 10-15% a year, which is significant compared to when you put your money in the bank. Of course, your money in the bank is federally insured. S&P or depends on what happens to those stocks of 500 S&Ps. Of course, if one of the companies out of 500 goes bankrupt, your money is still there because 499 more companies are still in the business. They will go up hopefully, and you make money on that. Therefore, that is called exchange. This is exchange traded fund ETF that is following S&P. When S&P goes up by 1%, your $500 goes up by 1%, which means becomes $505. When S&P, the basket of those 500 stocks, their value drops by 1%, your $500 drops by 1%, which becomes from 500, 499. Therefore, you might say you don't like exchange traded funds. Can you buy mutual fund? Yes, this mutual fund also has a value on it. When you imagine if it is $500 you put on this mutual fund, then this mutual fund puts your money, and the same thing that this one does, distributes between these 500. If it goes up by 1%, this goes up by 1%. As we said, the difference is this one goes up regularly, instantly. At 9 o'clock it might be 500, at 10 o'clock in the morning might be 501. But on this one, if it is 900, 500 at 9 o'clock, at 10 o'clock it is 500, 11 o'clock it is 500. Then when they close the stock market, then they calculate to see how much it has gone. Let's say if this has gone from 500 to 510, then after 6 o'clock, 6 p.m., this will be, after they do the calculation, this will be $610, and this S&P 500 has gone from 600 to, let's say, 610 or 510. Therefore, they move together in terms of percentage. If this one goes up by 2%, this will go up by 2% instantly, and you don't see it going up at instantly, but at the end of the day, when this has gone by 10% after 4 o'clock, this will go up by 10%, and this will go up by 10%. Therefore, it doesn't matter. If you are an expert investor, you will look at it to see how the managers charge here. If, let's say, this is charging, the fee is 0.04%, this is 0.05%, then it's not significant amount of money, But suppose big time managers, they say, okay, let's go with this one because it has a lower fee. But you do not need to be worried as much about fees at this moment because the fees are so insignificant, 1 penny, 2 pennies with the amount of money that we do. But sometimes over 30 years, that makes a whole difference. If someone is charging you 1%, let's say if you have $1 million, and then every year they are charging you 1%, and this one is charging you only 0.05, after 10 years, 30 years, this $1 million of yours in here might become 3 million, but this one might become $4 million. You see the big difference when it is over a long period of time. But in short period of time, you won't see as much notice, but you always want to know how much the managers are getting. But as I said, if you cannot find that, that's okay. And then now the question remains if we should invest in real estate versus paper investments. And usually they say that between stocks and real estate return usually Adjusting, of course, it depends on where you buy your real estate, just like what stocks you buy. Usually, on average, they say, I heard somewhere that this real estate gives you half of what stocks give you. And in real estate, you do have other issues. Imagine if you have a real estate, it's a physical property you have, and you might have a rental income, but you will have issues regarding managing it, repairing it, paying taxes. You get a lot of calls. If there is a tenant will call you, might give you a hard time. But when you have money in the stock market, you don't get any call. Nobody disturbs you. Nobody takes you to the court. Nobody. Therefore, these are things that you have to, be careful when you want to invest in different. What are they? Are you a person that, can know how to handle tenant? Do you want to have the issue of tenant? In that case, if you want, okay, real estate might be a good option for you. And mutual funds have no maintenance fees. As we said, no maintenance fees regarding compared to real estate. The real estate, you have maintenance, things break down and you have to, but mutual funds, you don't have things that break down or something. And they are highly liquid. Highly liquid means that if you put your money in ETFs at 9 o'clock, in 9:30, you want to take the money out, you sell it and you take the money out. But when you have a real estate, you have a house, you want to sell it, it might take months, it might take years. And of course, these are not a kind of, they are not physical assets, they are on papers. And different personalities get involved. And real estate, more hands-on, and therefore diversification. Some people like to diversify their income and diversify different types of assets. Let's say that if some people who are rich people, they don't buy all the stocks. They put their money in cash, some of it in stocks, some of it in bonds, some of it in gold, some of it in real estate. Therefore, they have, and in the stocks you can divide that as well. If you don't want to buy real estate, you can buy some funds that invest in real estate. Do you see that? Therefore, you might say you'd like real estate, but you don't want to have a house or headache. Is that you think real estate might be a good investment? Fine, there are some, right? They call it REITs, right? And those are funds that invest in real estate. Example of 5, okay. Fake diversification. In investment, they always tell you to diversify, not to put all of your eggs in one basket. Imagine that you go and buy 5 stocks in your portfolio. But your stock, you come and say, oh, I have diversified my portfolio because I have 5 different stocks and they are all in technology. Because all of them are in the same, industry, which is technology. They are diversified in terms of having 5 different stocks. But your industry is not diversified. How about if you put 5 of them, one stock in technology, or one stock you buy in, let's say, utilities, one stock in drug companies like, Pfizer, therefore, that is more diversified than this. Some people, do not want to have as much diversified portfolio. They think that tech stocks might go up. They will go and say, okay, they don't care about diversification. They would rather to put all their monies in 5 different. The biggest mistake is that if you put everything in one stock, but some people think that the technology stocks are going up quickly, they say, why not? They will go and buy 5 stocks. But overall, professional investors, they say to, be careful and try to diversify. Now, if you suddenly find good stocks, you might think that here it is diversification here. You put some maybe in healthcare, tech stocks. Healthcare, I said drug company, but healthcare is a general term. You put some in bonds, real estate. International markets are important, and it can become international companies. Some international, you have heard of it. Toyota is an international company, or Nike, or different, therefore, and some cash, of course. Cash is a very important component of diversification, and the benefit of having cash is that if things go wrong, you already have something. If you do not have this cash and things go wrong, things drop down, the value drops and you need cash, you have to go and sell your stocks at a very low price. But if you have cash, you have good amount of cash. If these stocks drop significantly, you say, oh, this is an opportunity. I take some cash and go and buy these things at a low price, Therefore, always you want to have to make sure things are diversified, But there are people who, prefer not to have diversification. They keep cash and then they put their money in, stocks. Of course, here is only written, stocks. These two are, mainly referring to stocks. But we have more than two industries. You already know this industry, tech industry. You know healthcare industry. But we do have a consumer discretionary. That's another, another industry. Consumer discretionary is that you, as a consumer, at your discretion, when you feel you have enough money, say, oh, let's go and buy furniture. Therefore, that furniture is not a tech, is not in the tech industry. It's not a part of healthcare. Or you might say you want to buy some, some other, in other industries. Let's say you want to buy some energy, invest in energy industry. What is energy? You might say you want to buy stocks of Exxon or Chevron, or utilities companies. There are all kinds of, 5, 8, 9 different industries that it is good to be familiar with them. And then it is the tolerance of age. Usually younger people prefer sometimes to take a risk, because if something goes wrong, they have time to recover. You put the money in some stock, it go down, but again, you make money, you go, and then sometimes the younger people prefer to put their money in growth funds, because they are going up and up. And some students hear about some, SoundHound, they go up and up, and they prefer to put, in stocks and ETFs, exchange traded funds. But sometimes the retired people, older people, they prefer bonds or dividend funds. I showed you one dividend funds that was SCHD that I showed you. Those they give dividend because elderly, they are retired and they want to have some source of income. When they put their money in some company like Nvidia, which is a growth stock, they might not give dividend. These dividends are like interest. Those stocks don't give any, because they keep their money to grow their company rather than giving it to shareholders. But some stocks give dividends, sometimes like energy company, utilities, the drug companies, like, as I said, Pfizer, they like Lilly, and these are, they make their money companies and they distribute, money to the shareholders. Therefore, that's why older people prefer to have, and particularly we talked annuities. I know some students asked about annuities, and usually the people who, are older prefer annuities. Sometimes young people prefer to be in this category, and as they, they try to diversify as they become older and older. And we gave you a number. That's what professional investors say. They say that if you are, for example, 50 years old, 50% in stocks, and then maybe 50% in bonds. If you become 60 years old, 60% in here and 40% in here. When you become 70 years old, 70% in here and 30% in here. Means this is more conservative, because if the stock suddenly crash, let's say I am 90 years old, and then suddenly stock market crashes, my investment suddenly from 1 million becomes 500,000. If it was here, now to recover these stocks to come back, it might take 10 years. By that time I'm dead. Therefore, how nice it is if I put $1 million, most of it in here, because these, when stock market crash, these don't crash as much. They drop. This one loses half of its value. Of course, it's very unusual, but it takes, every 30 years, suddenly someone's portfolio, a stock market might drop by, significant amount. But here, is much safer. Therefore, older people, it all depends on their risk tolerance. And then here is what ChatGPT recommended. Pick a question that connects, Roth IRA, or choose the ETF versus mutual fund questions, and the questions are there. And then, example, if the students want, I don't think any of the students have any ETFs, but I strongly encourage if any student want to do a little bit risk, I will write the name of two ETFs here. And if you have a Charles Schwab account, you have to buy a whole share of this. But if you have Robinhood, or if you have, I know one of the students had a Robinhood account. If you have Robinhood, or let's say with Fidelity, they allow you to buy, a portion, a fraction. One of the ETFs I like is called FTech, Fidelity Technology. That is most likely $200, $300. If you have $10, you can invest $10 in this ETF. Another ETF that I like, SMH, and that is the ETF of AI companies. There are NVIDIAs in there, AMD there, there are very, very, a lot of companies that are dealing like Palantir, and these are, AI companies. And then this one most likely is $200-$300, but you might not have $200-$300. Schwab doesn't allow you to buy that, but if you have, Robinhood, which I don't recommend the students to open. I know some students have. Robinhood encourages young people to do a lot of trading and, do a lot of activities, but in the stock market, you don't want to do a lot of activity, buy and sell. You want to buy and keep the shares, buy good shares and hold on to them for a long period of time, and hopefully you will make a lot of money. Therefore, that was there was another here. I think these are the different industries that we talked, and we said when you put your money, you can put it in information technology industry. What are those companies in there? Like Apple, NVIDIA, AMD, Google, Alphabet, Meta. These are called a technology company. So, and then, of course, you see Meta in here, and because Meta, which is Facebook, also, while it is a technology company, it falls in communication services because it provides Facebook and other. And then again, look at here, Netflix. I heard this one might have a stock split. And these are another sector, which these are other sectors. One of them is communications. When we say you have to diversify, these are the diversification. You come here, consumer discretionaries. That means these are the one that you want, not necessarily you need. What are consumer discretionaries? They are clothes, travel, because if you have money, you travel, and companies that are representative of consumer discretionaries are Amazon, Tesla, Nike, Starbucks, McDonald's. You might, some people, investment managers sometimes diversify. You give them $1 million, they try to invest in different industries, a little bit in technology, a little bit in communications, consumer discretionaries, and consumer staples that are things that we every day need. We use a lot. Let's say Coca-Cola. And if the stock market drops, these usually do not drop as much because the stock market drops, the people become less, have less money. They go to Costco to do, their shopping because they always have to have chicken. You go to Walmart and buy things. Therefore, sometimes they call these as a little bit of defensive stocks. That means other stocks will in here suddenly drop significantly, but the stocks in this part, don't drop as much because they are consumer staples that the people need. Those who are worried about the stock market sometimes invest in here, and some of these companies got some dividends, Coca-Cola, Costco, Procter & Gamble. Then some people like financials. Financials might be good. And look at here, one of them is JP Morgan at Chase. That's a big bank, Bank of America, Schwab, Visa, Berkshire Hathaway. Healthcare, a lot of, elderlies, they like healthcare because they give good dividends, and your money, these are healthcare. And these are, again, when the stock market drops, these don't drop as much because the people need these. And actually, sometimes, the people, and some people, sometimes when the stock market drops, the people shift their money to maybe healthcare. Energy, again, you are familiar, Exxon, Chevron, and industrial airlines fall in this category. And you have heard of Boeing, UPS, Caterpillar, Lockheed materials. Chemicals are part of materials, and mining in that part. And you have heard of, Dow Chemical, you might have heard, you might not have heard this Sherwin Williams, but they fall into chemicals. And some people like to invest in real estate. You see, REITs, real estate. And example is that you can invest in, some funds that invest in public storage, and these are the, other funds, and investors can earn dividend from rent income. That means that sometimes these real estate funds give dividend because they provide rent. When someone goes to this public storage and get the storage, they have to pay money to the company that creates this storage. Then that company, when they get it, they distribute it between the holders of this fund trusts. Utilities are other segment, and as you see, you have heard of here. We know Dominion Energy in this area. Again, these are called defensive stocks, because if the stock market crashes, that doesn't mean we are going to this company we are not going to use any electricity. Therefore, these companies are defensive. They don't go up. The stocks don't go up as much. They don't drop as much as well. They give some dividends. Therefore, help students to understand the concept of diversification. Diversification reduces the risk, but sometimes reduces the return also. That means you might have make less money, but at least suddenly if something goes wrong, you do not go bankrupt. You're filed. When I say bankrupt, that shouldn't scare you, because that concept of bankrupt it means that sometimes you go for file bankruptcy. When you buy stocks, for example, regular stocks, the maximum you might lose the stocks that you have. It doesn't mean that you have to, you are going to be bankrupt, like the way we know some people go to bankruptcy courts now. That you lose you are, losing your just the money that you have invested, and hopefully you have put it in good stocks, solid stocks, blue chips, important companies. When you want to first start your investment, always try to go with blue chips, companies that are solid. Of course, blue chips sometimes is referred to the ones that give dividends as well. And then there are companies where great major companies don't give dividends, but those are, you may buy those as well. Palantir, and let's say Amazon. I don't think Amazon gives any dividends. These are great companies. Therefore, don't think if the company doesn't give any dividend, that's not a good company. Therefore, you want to know about these stocks as much as you can. And we discussed about, ETFs, XLK, therefore, that is a tech ETF. This is XLK, again, is baskets of stocks you buy. We already showed you, one ETF. Therefore, and we told you another ETF is FTech. Another ETF, I think this is called, many people have heard of QQQ. This QQQ follows the index of, we call this we said, if you remember, I said VOO follows S&P. QQQ follows NASDAQ 100. NASDAQ is another, index, and this index is following the NASDAQ. And NASDAQ is a basket of stocks of around 2,000-3,000 stocks. Mainly technology companies are there in that basket. That is will look just like Dow Jones. Dow Jones only has 30 major stocks. Maybe I make one time I lecture about these indices. Dow Jones, you have heard of it. Dow Jones means this is a basket of 30 stocks. The Nasdaq is a basket of 30 stocks. that has as many as maybe 2,000 to 3,000 stocks in it. Nasdaq 100 has only 100 in it. Then you will have, S&P is another one. Then there are different in the world. There might be one for transportation, Dow Jones Transportation. It only has a basket of transportation stocks. Therefore, we will talk, if we, run into more of these discussions, we will talk. But these are great stuff for you all know. And you all check the portfolio, check your 401k, see where your money is. Most likely in your 401k, you might not have. It means you can invest in your, mutual funds. You have to go and see what they are, and hopefully I may create another, video, show you different mutual funds. Most likely, if you have a 401k, most likely the money is sitting there and earning only 2% interest on it and a year, which is not a great number. Why? Because inflation is greater than 2%. You are losing your money if it is earning only 2-3%. Therefore, it's better to go there and see where your money is. There you can shift your money and take maybe part of it to learn and put it in mutual funds, and then see what happens. And hopefully these mutual funds, if they are good funds, they might go 20. If technology funds, a lot of technology funds have gone up by 20% a year, 25% a year. Some of them are international funds. They go up maybe by 10%, 11%. Therefore, you want definitely to know where your money is in your retirement account. Otherwise, it's not going to go as much, and you are on the losing part of the investment. Therefore, if you have any questions, you let me know. If you still want to have the $50, those of you who don't have, just let me know, send me an email, and I will help you to open an account.